the neutral rate of growth in the U.S. right now is 1.25%.
What does that mean?
That means basically the rate of U.S. growth that doesn't require people to come into the labor market, that can be met essentially with the existing, without the unemployment rate.
How do you jump to 4?
Going down.
What are the things happening above and beyond that get you there?
Well, the thing that's super interesting about what's going on in the economy right now is we're actually seeing a bit of reacceleration of those cyclical parts of the economy. So what you had was interest rates rose, the cyclically sensitive sectors like manufacturing and housing cooled. Basically, all the froth in those markets came right off, and then we all sort of settled down. Everything settled down, and people realized that actually 7% mortgage rates, given the tightness of housing supply, is not the end of the world. And builders have come back into the market. Prices have started to rise again. 2/3 of
demand didn't disappear. It was supposed to.
Yeah,
it didn't.
demand slowed, but because there's so little supply, the home builders are able to continue to produce homes, which is the GDP element that you're seeing in there. Plus, you have the fact that that prices are going up. Prices reached new highs in 2/3 of MSAs in the most recent period. So that's a very strong picture. And then, of course, we have to talk about the fact that there's a big fiscal impulse in the economy as well, which is extraordinarily unusual, running deficits the way that we're running in an environment where unemployment rate
is secularly low. It's for COVID.
But isn't that the biggest predictor of future inflation? Is like the demographics and all that stuff, you could see inflation coming back down and rates coming back down. But if the government keeps spending money, then that's like the big tell for inflation, is it not?
The Inflation Reduction Act the most stimulative thing that the government has done in 10 years?
Yeah, well, certainly
that's funny, right?
The act was definitely not disinflationary.
Okay,
right. Building infrastructure is the opposite of disinflationary.
That's right.
Maybe someday down the line, but building new roads, right, at 3.5% unemployment is incredibly inflationary, and that's exactly what we're seeing. And then all the impetus to build, non-housing investment, right, in order the CHIPS Act and all that stuff, which is creating a huge amount of fixed investment into, business fixed investment associated with that, stimulated by the government. You put all those things together, and we're basically getting a cyclical easing.
Yeah.
Right?
It's crazy.
In the midst of an economy that's about as strong as it's been in, 20 years, and a labor market that's as tight as it's been in 75 years.
So what does the Fed do? What are they supposed to do?
A different Fed chair might be more aggressive in talking to the White House and being like, okay, maybe no more new programs.
Yeah, I mean,
until we put this fire out.
It's normal, if you go back to the 70s, not as extreme. It's normal to get some fiscal stimulus, although this is pretty extreme given how good the economy is overall. I mean, the reality is that the Fed doesn't control the spending in Washington, and they have one thing that they can do, which is that they can, tighten monetary policy.
But Ben's question, though, I think that's the right question. It just, from not looking at the data, it just appears that the things that we do on the fiscal side have a much bigger multiplier effect than what the Fed is doing.
And quicker.
Of course.